Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our EIA show, and we're going to talk about, what happened with the numbers, why, if you go back to what we talked about last week, we were pretty much spot on with where things were going to go based on some of the noise that was in the number when we looked at gasoline, because remember, we look at multiple different data sets. We're not just looking at one to try to figure out, where some of this demand is going to be. So we had some of that move down in gasoline, which resulted in a build. That's something that will reverse next week. We expect to see, a little bit of a draw, but oil's the one where we continue to see this drawdown. And when you look at the assumptions on imports and exports, some things just doesn't seem right. And when you go through some of the numbers, especially the adjustment factor, you can see that there's still something hanging out, and it's going to take time to have that work through the system. But I think those exports are overstated with the imports being understated, and that's something that's going to flip next week. Again, this is why we're always looking at those 4-week rolling averages. It's more important to look at where the trend is. The trend is moving up for imports. The trend for exports is remaining fairly stable at the moment, but we think that will trend lower. Now, distillate, because headlines are headlines, so you have to kind of sift through the noise. So when we look at the products, gasoline was a counter-seasonal build, but distillate was supposed to build. Jet was a little bit of a draw. The demand is still a bit lackluster based on where we are as we come into really peak demand season, but we'll go through that in different pieces. And now, those are some of the highlights of where it is. And obviously there's the OPEC potential agreement, and we'll go through that in segment 3. But just for right now, just based on how these EIA data is looking, what some of the global data is looking like, it's gonna, like we said last week, really keep crude right where it is. There's not too much to say, oh, this is really breaking down or this is really breaking out. It's kind of steady as she goes, very much along the lines of seasonal norms, just at a reduced number, which is really, if you've been following us, we've been saying since essentially since March, when the narrative came that we were going to have this grand reopening. We said, look, things are going to get better, but it's still not going to get back to where we were, and that's where we continue to sit. Now, one of the things that we've been talking about since 2019, and I thought this was a really good chart that really kind of drives home what we've been saying, was it's not that we don't believe there's going to be oil demand growth, because we do. It's just what is going to drive that oil demand growth. Because when you hear OPEC talk about 100 million barrels a day of demand, or not just OPEC, but just news agencies and whatnot, we always think of and like to separate it in terms of liquids, condensate, NGLs, and black oil. Only because there is a growing demand on the petchem side, on the plastic side, and that's where we're going to continue to see that growth. The question is always going to be on black oil in terms of where is that demand function when you talk about LNG, LPG taking some demand away from fuel oil, distillates in general, gasoline coming to a peak for the most part. And not to say that, obviously we're going to take back what we lost in 2020. We will eventually get to the point and, maybe even exceed it to a bit. Because I'm not saying it's only going to be liquids. I'm just saying that is going to be the lion's share of where this growth is, which then puts into play wet gas, where some of the stranded gas, where some of these liquids, and you're going to start to see the numbers or the profit or the margin is going to make it worthwhile to capture some of these stranded assets that we have found over the last 5 years, where it's like, oh, we only found gas. It's like, oh, well, we found gas, and let's see how much liquids is behind it. So that's something to watch, because I think this is really the narrative that we've been picking up on and really been trying to drive home. When you look at the motor fuels versus the liquids, where the liquids demand, barely went down and immediately went back up. Where when you look at gasoline, jet, disties in general, you continue to see this inherent slowdown. And that slowdown, again, results in just less oil demand. And this is just looking at one piece of the pie. So again, this is just kind of highlighting what we were trying to call to action at the end of 2019. Obviously, it accelerated with COVID. But when we look at where the growth is, it remains at that LPG naphtha level, which is why we've launched that NGL product, because we really think the NGL side, or that bucket, is the one to pay attention to going forward. So when we're going to pull out the SPR, then we're going to talk about it in a second, because there was some confusion last week on why we're going to talk about the SPR versus not. But again, we'll get to that in a minute. We're just looking here on commercial crude inventories, and you can see that they're still maintaining the pace of drawdowns that we saw in 2019 and in 2017. Really just very much a seasonal move at the moment. It obviously started a little bit sooner, but even so, it actually started pretty close to where we were in 2017. So it's not too crazy to see where we sit. Now, the shift is going to come between imports and exports were very elevated, over 4 million, where we did get an increase in imports, but there's even more behind it and we'll talk about this more in segment 3. But West Africa, some of those sales were west of Suez, which just means that Europe and the US are now starting to buy more and more of West African crude, most notably Nigeria. And that's going to be one to watch, which is going to be important. As we said before, July loading shipments of clean fuels from Asia to Americas still remain elevated. That's going to be coming into Pad 5. So here you can see that we continue to see these drawdowns. And when you look at 2017, when you look at 2019, those drawdowns did go till about the end of August, beginning of September. And it's always going to come to, when is Memorial Day? When do we get that last spike? And then those builds, kick back in. But just, again, a seasonal move for the most part. And when we talk about SPR, and I guess I might as well talk about it here, when you look at the drawdowns of SPR or the Strategic Petroleum Reserve, that takes an act of Congress. And Congress has said that they're going to essentially sell crude out of there going to essentially 2027. And it's important because when the EIA or the DOE calculates days of supply, they don't include SPR. They only include commercial. So to include both of them as together, they really need to be kept separate, because you have to think of the SPR releases as almost imports, because it's only counted after it's been kicked out, not while it's in it. And that's some of the confusion, or at least trying to drum up some fun percentages and whatnot. But this is just one of those key differences between SPR and commercial that we just wanted to call out. And that's when we start looking at the days of supply. So they continue to move lower, very much in in the seasonal pattern. The pace of days of supply decline have normalized a bit. It's something that we think is going to continue to level off as, again, the draws will continue in crude. It's just the pace of the draws will adjust closer to, actually, I don't know if it pains me to say this or not, but when you look at API, the API number was one that looked much closer to what it should have been, where when we talk about a 4 million barrel draw. But those are some of those nuances that, again, we have to look at it on more of a rolling average just to see. It's like the draws will continue. When you look at the seasonal, everything always, even 2020, you had those seasonal drawdowns, and that's something that's going to continue through that time period. So then when we factor everything in, commercial storage, you can see we're right back to where we were in 2019. The draws have been, when you start factoring in products, because remember, crude is being cracked into something. It doesn't just disappear, and it's going into products. So we want to look to see what is in commercial storage right now. And when you look at where we are, you can get an idea that is very much along the same pace as 2017. And when you look at it in terms of where we are in 2019, it's the draws continued in 2019. We think at this point that the pace of draws will be very close to that level when you look at 2019 at this in terms of where those draws are, and then where those builds kick back up. So when we look at gasoline had a little counter seasonal build, but it's not something that is unheard of. And when you look at some of the 2019, when you look at what happened in 2016, after you have, obviously this is looking at storage, and it's when do things leave the system and go into the market. And when you look at July 4th, we had some of those hiccups in terms of truck drivers, getting gasoline from point A to point B. You had some of that noise coming in. So this is some of that cleanup, because as we were saying last week, that gasoline draw just didn't seem like it was the right number given where things were. And that's where now you're starting to get a little bit more notable adjustments. And sometimes we do get that, where you kind of prime the pump ahead of July 4th. You'd have the July 4th drawdown. Then you have a little bit of a timing delay in terms of when they leave tanks, go back and refill what consumers have pulled down. And that means that we'll just see another draw next week, which again is very seasonal. When you look at the general cloud and when you just look at where most of these numbers go, we will continue to see some of those draws. It's just going to be at a bit more of a muted base, as we've been talking about. Now, disti builds accelerated a bit, but when you look at it against seasonal norms, it didn't accelerate anything surprising. It was very much in seasonal capacity. When you look pretty much through every single year where you have the acceleration point at this level, we'll see that carry out through July and August. Really nothing to report of means here in terms of just, we're going to continue to see some of that acceleration. Now, jet normalized a bit, and this is what we've been talking about when you look at where, not only just where the storage is, but also where the demand numbers are. It's just going to go sideways at this point in time, just because we have had an increase in demand, but we've had an increase in recovery value for the jet kerosene. And that's where we're just going to continue to see that movement sideways, as we've been saying, and we'll talk about the TSA numbers in the next segment, where you see that they're at a seasonal point in terms of that elevated level, and now we're just going to go sideways. And as we've been saying since March or April of this year, or I should say both times, that we were going to follow the seasonal trend up, and instead of getting back to 2019 levels, we were going to have this pause point and then go sideways and just have a very seasonal move versus where we were in 2019. And so far, that remains the case. So then when we look at the futures curve, you can see that we're not much has changed all that much to that level. The curve has gotten a little bit higher when you look further down in 2022 through 2024, and things have gotten a little bit worse. But again, really nothing meaningful to talk about. There's going to be the OPEC moves will adjust kind of where things are going into 2022. But again, there's really not much change in general. Now, just touching on COVID cases, just because we continue to see some increases in Asia. Some of the extensions that we've seen have been in Southeast Asia. Australia has extended the lockdown for 2 weeks. People in Japan remain concerned about having the Olympics, but again, we're too close. They have no choice at this point. So that's where you have the state of emergency that's been declared. South Korea is actually pushed back up, but again, it's always important to look at where's case count, where's hospitalizations, where's deaths, because right now it still remains mostly on the case count side with very little increases, or I should say concerning increases in hospitalizations, where infrastructure could be at risk. So this is just going to be something to watch. There's really not much change. We still have restrictions in Southeast Asia that is going to limit some of that delta when we're thinking about demand. And then when we'll talk about China in more detail, but the UK continues to see some of those steady increases. The world levels have started to creep back up, same with the US and Europe. So it's just going to be something to watch. But so far, what we've seen is that vaccinations have been successful in keeping people, even if they do get COVID, it is a very mild case. It doesn't require hospitalization, anything significant outside of just your typical rest and recovery. So that's the positive. It's just going to be a matter of where are the vaccine levels, especially in Asia Pacific, and we'll go through that in more detail like we do every week in segment 2. Now getting to the draws, there was a draw of 7.9 million in crude, and you can see that there was nothing sold out of SPR at this time. So that pretty much holds the case here. The draws were driven by Pad 2, Pad 3, and Pad 5. Pad 2 had a draw of 2 million, bringing that about 14 million below the 5-year average. Pad 3 is where we continue to see those draws, draw of 12.6 draw of 5.35 million, which is 12.6 million below the 5-year average. But when we look at just what that 5-year average is, as we highlighted before, obviously you're starting from a higher level from 2020. So it's going to be a matter of when do we see some of this normalization, and that's when we'll go through in more detail what Pad 3 looks like. Cushing was down 1.59 million, getting close to that 15-year average. So then it's going to come down to what is working capacity. And now you might think, well, what is working capacity? So working capacity is Cushing has, obviously tank farms, but you have to maintain a certain amount of crude in them to have some natural gyrations of increase and decrease, because you never want the oil to go below the spigot line, which is off the ground, so that you have a certain amount of crude that's kind of left at the bottom of the barrel. You want to maintain some of those pressures. So that's where you start getting into this, well, what is, the operational level? We're still above it, but as we get lower, that's going to be a bit more of a question. And then you can see that there was an increase again of 100,000 barrels a day of production, getting us to 11.4. Now, if you remember, based on the Frac spread show, we've been saying that our target is 11.5 to 11.7, but much closer. We don't really think we're going to have an exit rate of 11.7, but it's going to be somewhere within that window. And this is why. It's because the Frac spread count is really a leading indicator for where production's going to be. So even though we had this big increase, you didn't see it right away. And then given this is running off of rigs, so rigs have now have started to catch up. But as we've been saying, it was going to be Frac spread counts first, then bringing back rigs. And then rigs were going to come back faster. Then we were going to add some of those spreads. And this is going to be some of that natural trajectory. But again, we will have production growth this year. We're assuming an exit rate that's going to be closer to about 11.57, 11.6. There's a chance that we get to 11.7, especially if some of these prices hold. But again, that's going to be a matter of, well, how quickly can we get labor, some of this equipment back in action. So again, there's going to be some delta in that. But 11.5, that low end is very doable. And realistically, it's closer to that midpoint. So now when we look at, going back, stockpiles actually rose last week by 600,000 barrels to just 620.8. So just when we look at where some of the builds are, you can see that things have leveled off a bit in the west of Suez. And then you had some builds that were a bit, I don't want to say counter-seasonal because they're really not. It's kind of, it was just excessive versus where things normally are. So you can see that we had some of those builds east of Suez. That was really driven by Japan. Shandong teapots continue to see some increases. So there was actually a counter-seasonal build on a global level, but we're just going to have to watch because, again, the average still has us as with net draws. But we did have an increase in floating storage. It increased by 1.8 million. So we had an increase of floating storage and we had an increase of onshore storage. And it's really increasing based along the lines that we've been highlighting. West Africa had a build. We had some small builds in Asia. Because remember, we were talking about you had a big increase in crude in transit. So crude in transit then leaves storage, goes to be filed under crude in transit. And then we get the crude showing up. And then it usually sits in storage for a little bit longer before it gets discharged into the onshore tanks. So again, just some of that timing delay, and we still have some of those COVID issues, especially in Southeast Asia, which is leaving some of that crude on the water a little bit longer, which is why we expect to see some of that east of Suez remaining elevated. And this is where we're seeing some of that show up, is when we look at road fuel demand. China remains around this 92 to 93% of normal. That is not something we see adjusting. Europe has come under a little bit of pressure, more just because there's been a little bit of a slowdown of restrictions being lifted, but it's really just more the consumer doing a little bit less just because they see some of the headlines. And it's just, do I have to go to the store today? Can I wait a week? And that's where we're getting some of that hiccup. And that's keeping us at about 90%. Now, North America, or really the Americas, has come under additional pressure. That's really driven based on Latin America and the U.S. Dropping back down after seeing that big surge for July 4th, because there was an increase for the seasonal side. So I'm not saying there wasn't. It's just that surge that was recorded was just a little bit too high, where rest of Asia continues to kind of go sideways. And if anything, there's going to be a little bit of a pressure to the rest of Asia, which is why we're going to see some of those additional builds in the storage centers within Asia. Now looking at Pad 3, you can see that the pace of draws still remains pretty much in line with where we were in 2019. It was moving with 2017, but 2017 has cooled off a bit as we get into the end of July, which is something that we expect as well. You get a little bit of a pivot where you just get, the paces slow down and then you kind of level off, especially as some of the imports that we're going to talk about, especially coming from West Africa, start to show up. Some of those exports drop just given where some of the spreads are, and just that the number just seems high for what it is, and that'll flatten us out. Still draws, don't get me wrong, especially from Pad 3, because where we have most of our refining capacity, or I should say the lion's share of refining capacity. But again, this is going to be something to watch specifically in Pad 3. Cushing, you can see we're getting close to that 15-year average, which is just going to be something to watch when we're looking at what's going to happen going forward. We can go lower. It's just, there have been tanks that have been added, and because you've had tanks that have been added, you can increase the amount that can go into the region, but you also have a certain amount that it has to remain to keep them functioning. So again, we're still away from that point, but that's just going to be something to watch as things continue. But just given where spreads are, you're starting to get that incentive to maybe store things a bit, especially in Cushing. So you'll start to see that flatten out as well. When we look at imports, the imports were up 349,000 barrels a day, up to 6.23. It's still well below the 5-year average, and that's really, again, driven based on Pad 3. Pad 3 did have an increase of 397,000. That's going to continue to trend higher. Pad 2 remains elevated, remains over the 5-year average. That's going to stay the case. It's just, Pad 2 had a small decline of 95,000 barrels a day, still well above normal. That's going to, again, stay at that level. And then Pad 5, we're going to see some additional increases of imports. And that's going to be what to watch of where are imports coming from, where are they going into, and we still see a large amount heading this way. It's just going to be a matter of when does the EIA calculate them, when are they released. There's going to be those timing delays, but again, the trend is going to be up, especially as we sit at about 91-92% operationally. So run rates were down small, 22,000 barrels a day. It was down 0.4 to 91.8%. There were two reasons. Obviously, there was a little bit of a slowdown for the holiday. There was also some unplanned downtime, and some of that is going to stay down just because there was already planned maintenance. The unplanned maintenance, just they said, look, let's just pull it forward. We have the product in storage. So that'll just pull down and keep us a little bit off normal. But again, we still think the trend is to 93%. And it's really going to be driven based on what we've seen out of Pad 3 at this point. Pad 3 had a small increase of 89,000 barrels a day. Pad 2 will come back a bit, and we'll get closer to that 92.5 next week, and then really trend closer to 93 through the remainder of the summer. And when we look at implied demand, so here's the kind of that big makeup number. The gasoline demand was down 760,000 barrels a day to 9.28 million. That's much closer to what we expected. When we looked at where we thought gasoline for July 4th was going to be, July 4th, we expected it to go to about 9.5, 9.6. That was confirmed again by Gas Buddy, Descartes. Instead, it came in at that 10.04. And now we're kind of back to that 9.28. And when you look at, again, Gas Buddy data, Descartes, they're right around this level going through the remainder of this week, or I should say so far through this week. So that's something where I think we're going to kind of hang out. We might get a little bit of an increase depending on when some of these barrels are released. It could go to 9.4. But again, we're coming into kind of this comfortable where we're going to be for the remainder of the summer. Distillate had a drop of 676,000 barrels a day to 3.16 million. That's, again, you had that drop in demand because, again, truck drivers weren't driving as much during the holiday. Everybody likes to celebrate the 4th. Then you'll start to get back to normal. So we'll see that reverse. Jet had that spike of 186,000 barrels a day that we talked about last week, back to about 1.56. Again, it's 1.3, 1.5 is going to kind of be that level that we think we're going to stay in, and we're going to continue to see some of those movements. Now, when we look at European gasoline arrivals in the U.S., they bounced to that 5-week high on the 7 days through up to this point. Through July 1st and coming into July 7th, increased to 483,000 barrels a day. We're continuing to see some of those increases. Then we're going to have a little bit of a drop off. It's still going to stay above seasonal norm, but again, it's going to move more along the seasonal lines. When we look at floating storage, you had a small increase, which is going to continue to move closer to the bottom of that cloud as these boats show up, and there's that timing delay of when do they go from floating storage into the U.S. Then when we look at imports into PADD 3, as we've been saying, they're going to continue to push closer to the bottom of that cloud. We don't see that changing. We think it's going to continue to drive higher. Again, that timing delay, we think the imports are a little understated, which means that we're going to get, even if they're down based on what we're seeing on tracking, it could be on a filing matter. So again, we still think that we're going to get that increase into the bottom of the cloud. PADD 2 continues to remain well above the 5-year average, and just based on everything that we're seeing on PADD 2 runs, PADD 2 demand, it's going to continue to be above the 5-year, below the top of that range, but again, within, strong within that cloud. Just off that 29-year average. But when you look at just kind of where we sit, as we've been saying, we think that we're just going to hang out at about that 93%, which is that 29-year level, which we continue to believe to be the case. And then when we look at some of the distillation capacity in the U.S. that has declined in 2021 so far. So remember, in 2020, we did have some things come offline, get switched to renewable fuels. We did have the mishap in Philadelphia with the explosion. So we did come down in the available capacity. And this is when it comes down to, well, how much storage is right storage? Well, how much capacity do we have? And you can see that with the capacity is moving in the quote unquote wrong direction. And it's going to continue to decline because we do know that there are facilities slated to stop operations in 2022 and in 2023. So we'll continue to see that move lower, and it'll be replaced by some of that new capacity that's being built, not in the Middle East, as well as Asia, and most importantly, where some of that new capacity is in China. So those are some of the shifts. And now in segment 2, we're going to go in a bit more depth on what happened with the products and where do we think the products are going to go from here.